Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending October 8, 2021. So let's start with a look at this week's markets after 4 days. So negative for bonds, positive for stocks. So let's start with bonds. Interest rates are again higher on the week. Interest rates tend to rise with prospects for better economic growth and for prospects for higher inflation. So we're talking a lot about growth and inflation this week, and you'll understand that the trend is pretty strong in interest rates right now, and it could stay strong for a good while. So negative on the week, negative year to date. So the picture for 2021 could be a bit negative for bonds, but we'll be discussing that in a few minutes. Equities, the TSX outperforming on the week, outperforming year to date. On the week, we had positive returns pretty much on every equity index. But when you bring everything back in Canadian dollars, with the rise in the CAD on the week, on the back of stronger oil prices and a very strong jobs report today on Friday, to add on top of this, you have a very strong outperformance of the TSX in Canadian dollars versus the other indices. So price of oil, as I mentioned, higher, CAD higher, euro lower, and gold remains under pressure, still negative year to date. So jobs report here, strong advantage Canada, can't stress that enough. Here, this chart we've been using for a good while. So what we did is that we looked at the peak in February 2020, built an index. You can see both Canada and the US lost about 15% of their jobs at the beginning of the pandemic, and then we've been in rebounding mode. Canada's been rebounding with some zigs and zags, but still with a very stronger trend. And now it's official. We can be proud of that. 100% of the jobs that were lost have been regained. So it's not many developed countries that can say that. So a very strong point here for Canada. In the US, we're only at 78% of the jobs that were lost that have been regained. So if you look at GDP, you would say, well, the US is outperforming Canada when you look at GDP, but when you look at the labor market, it's completely the opposite. The Canadian economy, in our opinion at IA, is on much stronger footing because its labor market is much stronger than the US. So it was 157,000 jobs added in September in the country. That was enough to bring total employment back to pre-COVID. And in the US, that's the second consecutive big miss in a row, only 194,000 jobs. So the big question is this enough to give the Fed the green light to start lifting its foot off of the accelerator? So remember that the Fed, just like the Bank of Canada, the Fed is the central bank of the US, of course, for the benefit of everyone. They put interest rates on the floor at 0% and added quantitative easing, which means printing $120 billion a month to buy 5-year, 10-year bonds, so all over the yield curve, to keep these interest rates artificially low, to have easier credit conditions if you want to have a mortgage, if you want to borrow to buy furniture, cars. Well, you have a lower rate by doing that. So now the Fed and the market and us, we agree, but we think it's time to start fading that back slowly. So we call that tapering. So tapering should start by the end of the year. But Mr. Powell, the chairman of the Fed, did say in September that we need at least a decent, that was his word, decent jobs report in the US. So 194, that's a big miss. If you add the revisions to the prior months, which were at 169,000, you get 333,000 new jobs added. So we think it makes the cut for a decent enough jobs report, but let's see what the market thinks. The risk premium on that will pretty much creep back into the market, but we'll see. We think the conditions have been met. Commodities now, commodity index here, as you can see, that's we're at the peak of about 11 years now for the price of 10 years rather, for the price of commodities. When I go through the list here, the price of oil is much higher because of underinvestment in the last year following COVID. So price of oil is high. Natural gas, well, we're making a green turn in Europe and in China, and so we are relying more on natural gas to produce electricity. Lots of demand for electricity, so natural gas prices are through the roof around the world. So there's that. Price of propane is higher. Fertilizers and farming costs, so that means food costs, higher. Coffee because of droughts in South America. Cotton prices because of droughts in the US. Those are all the commodities that made the news this week for reaching all-time highs or having a very strong upward trend. So inflationary pressures will remain with us for a good while if you look at all of this list. So that brings us to the theme that I mentioned earlier in the financial markets. Bonds, the bond indices, the returns on bonds this year. So on the left, you have the interest rates. As you can see, we started the year at a very low level. This is for 2021. Then we had a huge rise in interest rates in the first quarter, and then a pullback. And then now we're starting to go back up because we do see strong growth ahead, but we do see more and more inflationary pressures. So interest rates higher, that means the price of bonds go lower. So that brings me to the chart on the right. You have the returns for the US bond index all the way since the early 1970s. And as you can see, it's very rare that returns are negative. This would be the 5th year only since the 1970s, since early 1970s, that we have a negative return on the year for bonds. So what that means is that you want to have bonds in your portfolio. They tend to have positive returns. So even if we've been favoring stocks over bonds, that doesn't mean that we want only stocks. We don't want any bonds. Diversified portfolios this year, you have 20% return on the TSX. So even if you have some a bit of a headwind from bonds, you still have very, very good absolute returns in a diversified fund in 2021. So no worries there, but it would be very unlikely to see this trend turn around. You need to see interest rates crash pretty quickly, so that it would take quite a stock market correction. So it's quite unlikely. We want bonds in a portfolio to diversify. If there's the crash in the stock market, your bonds will be getting some value, stabilizing the value of the portfolio. But still, it would be it's a reach to expect to have positive returns in 2021 for a bond portfolio. But now on the flip side, if you look at stocks, well, you know that we've been decidedly neutral for a good while. We took some profits early in the summer, and we saw the balance of risk being not as favorable to add risk to the portfolio, add more equities. But now we're starting to see this here, that the market might have already corrected, but underneath the surface. You know that in the stock index, the weight of Apple, of Microsoft, all of these big names become so large that you can have the average stock just having a correction. But if these big names still do well, then you'll look at the stock market and you say, well, the stock index is only down 3%, 4%, so we're not there yet. But when you look under the hood, you see that for the S&P 500 and the NASDAQ, right now, 9 stock out of 10 have already had a correction of 10% or more. In the Russell 2000, so US small caps, it's close to 100%. So we've had the correction under the surface. And the average decline from the year-to-date high, well, 17% for the S&P 500 and 40% for NASDAQ, 34% for the Russell 2000, with the index not really correcting. So that starts to give us a very good base for stock pickers to add more risk to the portfolio, to invest more in equities. So we are just about to enter earnings season right here. So we'll see what comes out of that. We're not in a rush, but don't be surprised if we start to add some more risk to the portfolios and we start to warm up to the idea of adding more stocks to our asset mix. And seasonality, I mean, it's not the base for a strategy, of course, but you can't ignore the Q4 effect. So here are the average returns since 1950 for the US stock market, spliced into quarters. So Q1, Q2, Q3 returns of 2, 2, and 0.7% on average. And the positive rate is 63 and 62% respectively. So 63, 62, 62. So on average, you're higher at the end of a typical quarter. And it's about 6 times out of 10 for the first 3 quarters. But when you look at the fourth quarter, well, the average return is 4%, and it's concentrated in November and December. So the end of the year effect tends to be pretty strong. and it's about 80% of the time that Q4 is positive. So we can't really ignore that. So that's another reason to be at least tempted to look into adding more to our equities exposure. So we're warming up. We're already doing some things underneath the surface, but don't be surprised if you hear us becoming more and more positive and adding more risk to the portfolios as we move through the next week or month. So what to watch next week in Canada, we'll have manufacturing sales. In the US, we'll have the minutes from the September 22 Fed meeting with the jobs report we just had. It's going to be an interesting read. We'll have inflation, retail sales, and the University of Michigan Sentiment Index, which has come to the top of the pile right now because it was so downbeat the last few months. So to follow us, ia.ca/economy. If you want to subscribe to our newsletter, you can put your email in the box that you see here. If you want a copy of this presentation, just write at economics@ia.ca and we'll send you a PDF copy of that. So thank you everyone for following us on a weekly basis, and I'll see you again next Friday.